It's time for In the Money, Stock Market Action on AM 820 News. Here's Chief Market Strategist Gareth Soloway from InTheMoneyStocks.com.
Good afternoon, everyone. Hope everyone's doing fantastically well today on this Sunday, March 23rd, 2014. It's time to have some fun, folks. And by fun, I mean it's time to learn how to profit in any market, no matter if it's going up or down. And that's ultimately what I'm here to do and help you do across the board. Always remember, folks, the markets are going to go up and down throughout your lifetime. And it's important to learn how to profit in not only an up market. Up markets are easy. You go long, you go to sleep, and you wake up with a nice nest egg. But the markets, frankly, aren't doing that anymore. All right, over the last few years, in fact, over the last 5 years they have, but go back to 2007 when we topped out and we had a major collapse. All right, think about that. Think about how many people lost their retirement savings because they had just put all their money to work in 2007 before the collapse. Now, why did they do that? I mean, think about it. Why on earth would you ever put your money in at the top? Well, the average person doesn't know it's the top. The average person is told by the media, is told by analysts who are upgrading stocks in the market and price targets on the S&P that it's a great time to be in. And, I mean, think about it like that. I mean, everyone, you walk around, you talk, everyone's all happy. It gives you that emotional surge to go in and buy stocks, and then all of a sudden the floor drops away from you. And the market collapses, and you're sitting there trying to figure out, wait a minute, is it going to bounce back up? You know, do I have to take a loss here? What should I do? Before you know it, the markets have declined significantly. And it's important to understand to make money in that market, you don't have to be anything special. You don't even have to know that much. You just have to know about the game. And the game's the game being played, and you have to be willing to short the market, or at least, in the very least, pull your money into cash. And again, a lot of people have 401ks and IRAs, and you really can't short the market too much in those. You can play ETFs, which are short the market, and you buy it, for instance, and that's how you short. And just to make sure everyone understands what shorting is where you make money when the markets come down. So basically view the markets as a vehicle like a roulette table, right, or something like that. You can either put money on black or red, and you make it on whichever one. I mean, if you put it on red and it hits red, then you make money there. And if you put it on the other side, you make money there as well. So you can really play the market just like that. And I don't want anyone to think the market is gambling, because it's not. All right, if you have no clue, yeah, of course, it's you're going in blind with both hands behind your back and your feet tied together. But if you just understand a little bit about the markets, you can make money. So that's what I want to accomplish here. I want to give you guys some insight into the market to understand where this market is going in the short term. And I'm really a shorter term investor. Long-term investing is dead. All right, you'll hear more and more people over time say that. You know, Nick and I, my partner and I at InTheMoneyStocks.com have been saying that for ages. And that's why we've made so much money over the last 5 years, while the average person, has been making, decent returns, but now more so. I think this is the time to be a proactive investor and be ready for the next move, because it's not going to be up, folks. Frankly, it is not going to be up. The piper basically has to be paid at this point, as the markets are setting up to start their downward trek. And I've told you guys this since the beginning of January when I began this show. My goal is to make you an informed investor, not someone with a hood on or a blindfold on who's just blindly listening to, the financial pundits out there. I want you to be on that right side, and the right side, unfortunately, is down. And I wish it wasn't, frankly. I wish we could all just stay long and make money for the rest of our lives. But if you can make money on the downside, and then you know when to get along again, when you know when to buy again, you can just make so much money in this market. All right, what are we doing today? All right, today we are going to be looking at last week's market action, which was probably one of the most fascinating weeks in the market this year, if not in multi-years. And I know that sounds strange because the markets really didn't do a whole lot. They had some whippiness in between. We saw a gap up on Monday and a rally on Tuesday before a Fed sell-off on Wednesday and then a reversal on Thursday. I mean, there was a lot of whippiness in a tight range, but the signals out there were eye-opening. And I'm going to try to explain it to you and get it to you guys so your eyes can be open and you understand the significance of what happened. All right, so let's start with last weekend. All right, so I did the show last weekend, last Sunday. And we came in to last Sunday with a Thursday and Friday prior of weird action. Now, weird, what do I mean by that? Well, the market had a big drop on two Thursdays ago, not this past Thursday, but the previous Thursday. We had a nice big drop. It was from a gap up, which is a move higher initially in the markets, and then a reversal to the downside with a strong sell volume to it. And then on Friday, we closed on the S&P lower than Thursday's closing price and Thursday's low. So what does that mean? All right, when you have a big reversal in the markets, when you're near your whole all-time highs or your 52-week highs, and then you see the next day close below those lows, what I refer to that as is confirmation. What does that mean, confirmation? Well, confirmation means that you're solidifying a change in short-term mechanics of the market. All right, it's showing you something. Because generally what we've seen, if you go back multiple weeks prior to that, you see a down day. Sure, we got a down day. 3 weeks ago we got plenty of down days. We got a down day here, down day there. But the next day, the market would not close lower than the lows from the previous day. We wouldn't see continuation selling. We'd see a pause, or we'd see a big snapback, a negation of that entire move down. But you wouldn't see two consecutive down moves with the second day closing lower than the first. We haven't seen that since late January when we had that nice 7% correction in the markets. Now, that finally happened going into last weekend. And what we saw then is me initially come on the radio here on In the Money Stock Market Action here on 820 AM News Talk Radio. And I said to you, all right, that's a signal. That's something that raises a big red flag. It's a flashing light in my eyes that something bigger is going on here. All right, and we said going into last week, all right, this could be the beginning of it. Let's see what happens. Well, interestingly enough, we were coming into the weekend with the Crimea vote. All right, on Sunday, as I was doing the show, the Crimeans were voting on whether or not to become independent and really then join Russian Federation. And they ultimately, everyone knew they were going to vote that way. But I think the big worry going into the weekend was whether or not we were going to see the Russians kind of encroach on the rest of Ukraine. Were we going to see invasion forces go outside of Crimea? Well, how was President Obama going to react? Was he going to impose harsh sanctions? What was he going to do? So there was a lot of unknowns, and that kind of made people a little nervous. Well, by Monday morning, we knew the vote went with the Russians, and they joined Russia, essentially, and there was no further encroachment on the rest of Ukraine at that point. And we ultimately found out very early in the day that President Obama was going to impose minor sanctions. And the funny thing about these sanctions, and I joked about it last week on my smaller segments that are right around the 8:50, 8:40 time frame in the morning before the market opens, and about 4:53 in the evenings, where I just come and give you guys an update Monday through Friday on 820 AM News Talk Radio. But it was so interesting because the sanctions that were imposed had been talked about for weeks, about like blocking off money, and so any wealthy Russians who had money in the U.S. had weeks to move it if they wanted to. They knew these sanctions were coming down. So essentially it was a non-event. It was a total non-event. The markets gapped up on Monday pretty substantially, and they continued to bounce back, and that's what we saw. We saw a nice gap up on Monday, and then the rest of the day went sideways. Tuesday markets continued to rally, and all of a sudden, and this is where things get amazing, this is where I started saying, holy moly, this is big news here. All right, because the markets by Tuesday had reversed to come right back up to that Thursday high. Now, remember, the previous Thursday was that gap up and reversal in the markets where they flushed big, where we confirmed on Friday. So by Tuesday, we were right back to that pivot top from the previous Thursday. And this is where it gets nutty. The market's hammered on that level. Imagine with a big mallet smacking into that door over and over and over again. And they couldn't break. They could not get through that level. And then Wednesday, we all knew Janet Yellen was going to be talking. We had the FOMC statement. And again, early in the day, the markets were basically flat, but they were hammering and hammering at that technical resistance level. And this is what you have to pay attention to when you're trying to get a gauge of the overall market. And that's what I'm here to try to give you guys, that insight. This is insight you're not getting from CNBC, Bloomberg, Fox Business News. No one's talking about this to you guys. As an average investor, they think it's above your head. I think you guys can grasp it. I think you understand and you want to learn more. You just don't know where to go. All right, so again, hammering on that level over and over, and then Janet Yellen speaks. And what does she say? She says, oh, by the way, yeah, sure, we're cutting another $10 billion in printing of money. So they go from $65 billion a month to printing $55 billion a month. Well, we all knew that. That was no big deal. But then she says in her press conference that interest rates may start to go up as soon as a year from now. That was sooner than the market expected. And all of a sudden you saw selling in the markets, and pretty precipitous selling at that. The markets really came down very, very quickly. So all of a sudden everyone was wondering, okay, well, the markets are collapsing. Will we see follow through on Thursday, right? I mean, that's what it comes down to. But I think as an investor, as a trader, as a technician of the markets, my instinct is to notice and kind of harp in on the fact that that Thursday previous gap up could not be taken out. And then you see that fall on Yellen's comments, Janet Yellen's comments. And then all of a sudden on Thursday, guess what happens? Well, the buy the dip mentality is back and the markets come back up. And this is giving the average investor a false sense of security, because every dip, the markets get bought back up. And it's almost like a self-fulfilling prophecy, because everyone starts to believe that they're going to bounce back up, so therefore everyone wants to buy it. When everyone buys it, then it does bounce back up, right? I mean, it's just a self-fulfilling prophecy. So the markets, again, on Thursday, after that sharp sell-off of Janet Yellen, bounced back. And they came, guess what? Right up to that same level again. That previous Thursday, the 1 week prior level, that key level, and again they started hammering on it. And I just imagine in my head, someone with a jackhammer or someone with a sledgehammer just trying to break down this double reinforced steel whatever door. And the markets couldn't do it again. Now this is where it comes into Friday. This is this past Friday, this Friday we just came into the weekend off of. And everyone was just watching. Can we break this level? Can we take it out? And guess what? The markets on Friday gapped above it. So they opened higher than that level. Now, the average investor would say, uh-oh, we're above it. This is huge. Markets should be free here. Wrong. It's all about where the market closes. So if any previous day we had gone above it by a penny, by a mile, doesn't matter. You watch for where the market closes. The closing print is what's going to make those algorithms that these big institutions have trading this market, that's going to matter to them. And that's going to matter to any big Wall Street trader like myself who's following the markets. The markets, again, on Friday were above it, and they were holding steady. We saw a little bit of a pullback early and then a move right back up towards those highs, again, above that level on the S&P. And then just as if the faucet was turned off, the market began to fall. And they fell all Friday afternoon, all day long, ultimately closing the day negative. All right. By the end of the day, the markets ended down. S&P down 5.5 points. Dow down 28. NASDAQ took a biggest beating of all, down 42.5 points, basically 1%. Now, you might say, well, who cares? Dow was down 28 points. No big deal. All right. S&P down 5.5. No big deal. But it was. Why? Because we didn't close above. We didn't stay above that key level from the previous Thursday. And in fact, the S&P during the day made a new all-time high and then still got smoked back down. Technically speaking, that is huge. All right, now, why is this happening? Why is the market having so much inability to break through this level? And this is what I'm going to leave you with before we take a quick break here. Okay? And simply put, I'm telling you this, and I'll tell you till I'm blue in the face. The markets are seeing selling by the big boys as the small investor who's blinded by greed, who's blinded by the fact that they think they can buy up here and make easy money, just like in 2006 and 7. Every investor buying a house thought they could make easy money. They're buying, and smart money is selling. Smart money like me, I'm shorting the market. I shorted it prior to Wednesday, and I covered some of my shorts there. And guess what? I'm shorting the market again as it comes up here, and I did so on Thursday and Friday once again. And I'm just doing what every intelligent investor's doing. But there's so many smaller investors who don't have the knowledge that I'm trying to convey to you, all right, that they're just, that money's just flowing in the market, keeping it afloat. And that's scary, because those are the people that, honestly, they can't afford to lose money. And they're the ones that are buying at the tops. All right, we're going to take a quick break here. All right, my name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. This is In the Money Stock Market Action on 820 AM News Talk Radio.
Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
Welcome back, everybody. Great to be with you again on this Sunday as we get into more action here on In the Money Stock Market Action. My name, Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Don't forget, there's a 7-day free trial at my website, again, InTheMoneyStocks.com. I would suggest most of you will fall into the Research Center, where we give out trade alerts, which are swing trade alerts. We also have a chat room, which is a day trading chat room. But again, most of you guys won't be too into that, because it's really time and time-focused energy, where you're looking for trades intraday. You're in and out of 30 seconds, and you really can't work a normal job with that type of action, as you got to be focused on the market. But the Research Center 7-day free trial is for everyone, as we will educate you, we will teach you, we will guide you through this market, putting you on the right side of the market for the next big move. All right, to go into the next segment here, we're going to go over last week's trade alerts, and I want to then focus in on the current trade alerts for this coming week, because let's be honest, we all want to make money. And that's what I keep doing for you, all right? Do I have like an occasional loser? Absolutely I do. But no one is perfect ultimately. And anyone who tells you, by the way, that they've never lost on a trade is definitely pulling your leg. So be always aware of that. The key is you want to have a high win rate, a high percentage. Just like a baseball player, wants to bat 300 or better. A basketball player wants to score 20-plus points in a game and have a shooting percentage better than 50%. As a trader, I try to bat at 80%. All right, that's my goal. I'm going to have a couple losers out of every 10, but my goal, again, is to bat around 80%, and that's enough to put you in the Hall of Fame if you can do that and make you a lot of money. All right, that's what our methodology does. That's what our study of the markets has achieved. Now, going to last week, folks, I gave out 5 potential trades, but 2 had triggers on them, which means that they had to hit specific points that I gave you, in other words, to be buys. All right, one was a price line long at $12.35, and it expired on Tuesday at the close if it did not hit $1,235 per share. Ultimately, it didn't hit that, so crossed that one out, never triggered, and it just kind of chopped the rest of the week. It moved up nicely early in the week and then came kind of down a little bit later. But nonetheless, that was not on the table. So that left four trades remaining. The other one that had a trigger on it was TZA. TZA did trigger on Monday and chopped around, went lower as the markets rallied, but ultimately came back to close flat for the week. All right, I gave it out at $14.95 as a trigger. It triggered that on Monday, and it closed the week on Friday at $14.94. So really a penny to the downside, but we'll call that a flat. Nonetheless, I'm going to still give $100 to charity for that. Any flat trade, I'm going to give $100 to charity, because charities always need to benefit, folks. And remember, we're coming into the end of the quarter, which is where I'm going to write a check to Metropolitan Ministries for the entire amount. And right now, that amount, including this week, is $1,750. It's a nice change. And again, it's great to hear. I've heard over the last couple months some people donating a little bit to charity as they've made money off of the trade alerts that I've given. And that's really what it's all about, folks. Again, for those of you that are traders, investors out there, if we want to make more in life, we always have to give back. So remember that. All right. Last week, I gave out a short on Facebook at 67.72. It closed at 67.24. That's a 48-cent gain, or a 0.7%, so 0.7% gain. The big winner last week, was GLD, was a short on gold. We knocked that out of the park. I shorted the GLD per the last Friday's close at 133.10 based on the chart being extended into multiple resistance levels and factors, and ultimately it closed at 128.47. That was a gain of $4.63 on the GLD in 1 week. That's a 3.5% gain right there. The last play that I gave, remember we only had 4 this week since Priceline did not trigger, was SDS, which again is a long SDS, which means you're 2 times short the S&P, essentially. I gave that out at $29.37. It closed at $28.62 for a loss of 75 cents, or 2.5%. So net, a nice positive week. Not a hugely positive week, but nonetheless, just continuing to give out overall success. And that's what we try to do. So really just 1 loser this week and 1 flat, and then 2 winners. And again, the biggest one was a winner for 3.5%, which was a short on gold. All right, let's get into this week, folks, because I want to get you guys these trade alerts. In just a little while, we're going to listen into a conversation that my business partner at InTheMoneyStocks.com, Chief Market Strategist Nicholas Santiago, had with Bill Fleckenstein. And again, he's a hedge fund manager, a big-time hedge fund manager from Fleckenstein Capital. And he's going to give us his insight on the markets, what he's seeing, what is he understanding from the Fed as Janet Yellen is talking about potentially raising rates. So we're going to go into that after the next little break coming up. But before we get there, I want to make sure you guys have the trade alerts going forward. And we're going to stick with some of the winners that have been paying us, and we're going to stick with some of the overall calls. I mean, based on Friday's reversal, based on the fact that this market cannot get through that previous Thursday's gap up level, I mean, we're just got to stick with what we're doing and what we're doing right. So let's stick with SDS, along on SDS again, 28.62 per the close on Friday. That's number 1. Long SDS, $28.62. Next one, TZA. Closed flat for us in the past week. Let's stick with it. So long TZA at $14.94. We're going to stick with Facebook. Keeps making us money on the short side. I think there's more downside. I think Facebook is a bloated pig right now. It's going to have a couple moves to the upside, but for the most part, we'll see it to the downside. And they're buying WhatsApp for $19 billion. I think ultimately that was the nail in the coffin. Paying $19 billion after, the stock being up. And again, to see it rally on that news was ridiculous, but it gave us a better entry on our short. So bottom line is, short Facebook, $67.24. I think it's going down to about 65 to 64 potentially this week. And a short on Hewlett-Packard. This is a new one, folks. Short Hewlett-Packard, HPQ is the symbol, and that's at $31.95. Why do I want to short Hewlett-Packard? All right, well, if you look at the daily chart, and this might be above the head of some people, but I'll do my best to explain it. Hewlett-Packard has a topping tail. All right, it gave us a topping tail on Thursday, which is a major signal. It's coming at basically multi-year highs. And anytime you get a topping tail like that, you have to go bearish on it. It's just telling you, it's basically pleading with you to say, hey, make money on me on the downside. So I'm not going to fight that. Hey, listen, it's telling me that. I'm going to go with it. These are the signals you look for in charts. And if you want to learn more charts, come to InTheMoneyStocks.com. But we're going to short HPQ per Friday's close, $31.95. All right, so that's $31.95. The last one is a short on UNH. UNH, all right, United Healthcare, $81.34. $81.34, $81.34. That also has a topping tail. So those are our trades. We're going to take a breather here. My name is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com, and this is In the Money Stock Market Action on 820 AM News Talk Radio.
Now back to In the Money Stock Market Action on AM 820 News. Here's Gareth Soloway.
All right, welcome back, folks. Getting into the second half of the show today, and it's going to be an exciting second half. Just to go over those trade alerts one more time for you guys to make sure everyone has them written down. It's a short on UNH at $81.34, a short on HPQ at $31.95, a short on Facebook at $67.24, and a long on TZA at $14.94, and a long on SDS, $28.62. So it gives you kind of a wide array, and we'll just continue to kind of grind out profits. And what I love about this, folks, is, if you look at the track record for InTheMoneyStocks.com in 2014, this far in, which we're almost 3 months in, we have a net gain of, I think, around 80+% for those 2.5, almost 3 months. Now, granted, that's if you put all your money in one play. If you divided it up with 10% in each play, you'd be around the just underneath 10% return for the first 2.5 months of the year. And mind you, this is while the market itself, and this is what you have to pay attention to, because you always want to outperform the market. The market itself is basically flat on the year. If you go to a hedge fund investor or someone and they say, oh, I made 25% in 2013. Well, who cares? The market was up 30%, so you underperformed the market. The key is comparing your performance to the market. That's what makes you a Hall of Famer, if you're beating that and beating that significantly. Okay? So a couple other things to go over here. We're going to get into an interview now, which I'm proud to bring you. My business partner, Chief Market Strategist Nicholas Santiago, sat down with Bill Fleckenstein this past week, and he had a great talk with him about what's coming in the markets. And again, Bill Fleckenstein of Fleckenstein Capital is an amazing, insightful man who has built an empire and built a following on his calls. He called the 2007 collapse absolutely correctly and made hundreds of millions, I believe, on that call, if not more. Unbelievable that he saw that coming, and he's going to tell us a little bit about what he sees coming in the market. So what we're going to do now is go right to that interview. It's my pleasure to bring you that interview now.
Welcome, everyone. My name is Nick Santiago, President and Chief Market Strategist here at InTheMoneyStocks.com. Today we have a very, very special guest with us. This is a man who is one of the few people that correctly identified the 2007-2008 stock market crash. He has been an outspoken critic of the Federal Reserve and all of its easy money policies. We're glad to have with us the popular money manager, Mr. Bill Fleckenstein. Bill, thank you for taking the time out today to join us here at In the Money Stocks Radio. Welcome to the show.
Hey, thanks for having me. Happy to be here.
No, it's great to have you. Bill, you've been an open and outspoken critic of the Federal Reserve throughout the years. What is their agenda and logic with all of the quantitative easing programs that they've implemented since late 2008?
As amazing as it sounds, they do not think that any of their policies led to the misallocation of capital that led to the equity bubble and the real estate bubble. They think that their policies only produce good, and they can solve problems, but they don't realize that they create them. So they saw a problem in '08, as everyone did, and their solution to it was to print as much money as it took to levitate the stock market and try to get the economy moving. The problem is printing money doesn't create jobs, it doesn't create economic activity, but it does foment speculation and misallocation of capital. So here we are on the third and wildest monetary experiment of the last 15 years. And we were right back seeing a lot of the same sort of behavior on the part of investors that we saw in 99 and 2007. And unfortunately, this is going to end pretty ugly when it finally ends.
Now, my next question to you is, in 2002, when the Fed started to lower interest rates, we really saw a pickup in the economy due to the housing bubble that was created. This time around, we're not seeing really much of an economic improvement. What do you think the Fed is thinking along the lines now that they've really gone so deep? I mean, they have about $4 trillion, I believe, on their balance sheet at the moment, if not more. What could be going through the mind of Janet Yellen or, say, Ben Bernanke, that this economy has really just slugged along? We have about 50 million people on public assistance, government assistance, I should say, and you have unemployment still very, very high at this moment. What could be going through their minds, or what are they thinking, and what is their next card? What is their next hand that they're going to play?
Well, I guess what they think is, boy, it's a good thing we were as aggressive as we were because, look, the economy's taken a long time to respond and barely done so. In other words, they're not going to look at the economic response and assume that their medicine doesn't work, and they assume that they didn't apply enough medicine, and then they kept applying more and more of the same thing, and now we've got a wild enough party that they convince themselves that everything's going to be fine, and thus they can taper. I think that basically the stock market is playing a game of chicken with the Fed, whereby stock bulls, are so confident because the market's gone, sort of been going straight up for 5 years now, and there's so much momentum behind the tape that they think that the market is forecasting a self-sustaining recovery and a return to the, basically a return to a Pollyanna-type environment. It's simply the money that's been printed that drove bond rates to where it did, and that has allowed other asset markets to get mispriced on the back of it. So I don't think that they really think. They obviously don't ever examine their policies with any sort of rigor, because if they did, they wouldn't keep repeating the same policies.
I come from the school where the bond market is usually smarter than the stock market. So generally the bond market will tell the stock market, hey, when the party's over. Do you come from that same school, and when do you think that will happen?
Not exactly. I mean, I don't think there's any such thing as a bond market vigilante, really. They're just carry traders. And if you go back to the period when Volcker raised rates to try to break the back of inflation, the yield curve was inverted and there were no carry traders. And without carry traders, the bond market had to be priced in a way to attract investors that were willing to own bonds in that environment and make the assumption and conclude that he would be successful. Thus, you've got the steep yield curve. So I don't think there's, obviously anyone who owns any fixed income piece of paper that, that's backed by the U.S. government on an inflation-adjusted basis has been, losing money for the last couple of years, maybe not in the 30-year, but so these bonds represent no value. You're getting cheated by inflation, but people happily do it because they can lever up and make a lot of money if they're levered up. Assuming that the Fed won't end the parties too soon, and I don't think the Fed will. So, I think the bond market or the currency market ultimately will will stop these Fed policies, but it's going to take a change in psychology of some kind about the negative consequences of these policies, or something to that effect. I mean, the primary beneficiary of this cycle's madness on the part of the Fed has been the Treasury market. You can't really call what's happened there a bubble like the prior two bubbles, but it's had a drastic impact on the valuation of certain assets, and we've got sort of bubble-like mentality in certain sectors of the stock market. Obviously, the whole country is not doing this. It's nowhere near similar in terms of from a sociological standpoint to what happened in the prior two bubbles, but we have had a massive misallocation of capital, and this party's going to end ugly like the last two did.
Do you think this next time when this is all over and the Fed has to unwind by the force of their hand, how are they going to unwind $4 trillion? How is that going to happen? They can't do it.
No, they can't. And so I don't know. I can't tell you how that hand will play out. If we were closer to a situation where they had lost credibility again for whatever reason, we could start speculating on what might happen. They might. I don't know what they're going to do. All I know is they could never in a million years sell those $4 trillion worth of securities or let them even run off. Rates are going to rise, and at some point, then that's going to undermine the stock market. It's going to undermine the economy, and we'll have a real debacle on our hands. The problem with that is if the Fed still has credibility, they can come around and do the same thing again. So if you're rooting for an outbreak of sanity and us to return to some sort of sound economic policies, and that also forces us to deal with the out of control government spending and the huge debts and promises, then you need the Fed to be stopped from its mission. If the Fed can't print us past any sort of trouble, then we have to fix our problems, and that's what we're going to need to do if we ever want the future to be like the past was before the Fed went crazy in the last 15 years.
Bill, we talked a little bit. You brought up the carry trade. Right now you have the dollar-yen carry trade that's going on. What do you see with Japan? I believe that their debt-to-GDP ratio has reached 300%. So what do you see going on in Japan? And do you think the Abenomics or the money printing that's going on over there can be successful?
Can't be successful. It can boost asset prices. It can depreciate the currency. It can create inflation. They're just taking a page out of the Fed's book, only they're doing it on a much bigger scale when you adjust the size of their program to the size of their economy. But people are back to believing the Fed knows what it's doing and its policies are prudent, and so they're following the same policy. And so when you think about money printing, you can't just think of the Fed. You got to think about the BOJ, and you got to think countries that link themselves to our currency. Those central banks are pursuing crazy policies. So there's madness on a global scale from a central bank perspective.
So basically, when this all ends, and we agree it's going to end in a disaster, I really don't personally see another way out, and I think you concur. When this all ends, will the Bank of Japan be the first domino to fall here?
Don't know. Could be the BOJ, could be the Bank of England, could be us. It's kind of hard to say. I mean, who knows which quantitative easing group is going to get into trouble first, or what wild card that no one saw coming leads to some other problems. You really can't say what's going to be the thing that changes psychology that starts to change policy, other than we know it will.
How about policies that are taking place in the United States? Right now we have the Affordable Care Act, or Obamacare as it's known. Do you think this is going to have any negative effects on the U.S. economy?
Well, I think it already has, and I think it probably will continue. I mean, it looks to me like anyone you've spoken to who's been impacted by Obamacare think it's a disaster. Obviously, some people have been helped out, but the whole scheme is not going to work because they're not getting enough young people to sign up to pay for it, right? So it's going to be a failed policy. We've got a lot of failed policies, but that fact doesn't matter. When the market stops going up and finally starts going down for whatever group of reasons, then people will focus on some of these issues. But right now, the bad news is just plain ignored. It isn't even contemplated. Mm-hmm. Doesn't matter what kind of bad news it is.
Yeah. It's just bad news is good news, and good news is great news.
All right, guys, we're going to step in here, and we're going to take a break in a minute here. But before I just jump off and we take a commercial break, then we'll come back and listen to the second half of the interview. I just want to remind everyone out there, if you're listening, you have a business in the Florida, Tampa Bay area, and you'd like to advertise and be one of our sponsors here at InTheMoneyStocks.com. And by the way, we have Jim Rogers coming up next week. So we have big names. We're continuing to bring out big names for you guys. If you're interested, call 212-380-1578. That's 212-380-1578, and you can be one of our elite sponsors here at In the Money Stock Market Action on 820 AM News Talk Radio. All right, guys, we'll be right back. Take care.
Do you invest or trade the markets? Do you want to know when the pros are entering and exiting the markets and what positions they're taking for multi-day swings and day trades? Then you need to join the pros at InTheMoneyStocks.com. Watch pro traders in real time as they trade, navigate the markets, even view their exact desktop screen on yours live. Start your free trial right now and trade with the pros instantly. Go to InTheMoneyStocks.com. That's InTheMoneyStocks.com. InTheMoneyStocks.com. Here's Gareth Soloway with more In the Money Stock Market Action on AM 820 News.
All right, back here. We're just going to get into the second half of the interview with Bill Fleckenstein in a second, folks. But just a reminder, next week, as long as the markets don't come up and close above that 2 Thursdays ago high, which was the major reversal we confirmed, I'm going to maintain that negative bias on the markets as we continue to see the big boys selling into the small investor buying. All right, back to the interview we go. I will talk to you guys at the end of the show there.
The Chinese economy. Now, the Shanghai Composite really has been tumbling for the last 3 years. Meanwhile, the S&P 500, Dow Jones have been making new highs. They're facing a shadow banking problem. They're also facing now new corporate defaults taking place. Do you have any take on China and its effect on the U.S. economy going forward?
Well, obviously China is, the authorities there are trying to wring out some of the past excesses. That's going to have a negative impact on GDP there as long as they keep doing this. And, Europe is not doing well. And so the people that think that we're going to have some sort of burst of economic activity here, given that, the rest of the world is slow and that we had problems from an economic standpoint before the weather got cold, people are now saying, ready to blame all bad news on the weather. I don't think it'll be that simple, and that sets up the market for a disappointment if things don't come roaring back once the weather settles down. There should be some pent-up demand, supposedly. And so I think the weakness in China will matter. I think that if the Chinese squeeze too hard and if things start to really come apart over there, that they'll go the other way for a bit. But again, from an economic standpoint, it's hard to see where anything really constructive is going on right now. I think the Chinese authorities are probably doing the right thing, trying to wring out the last excesses before the whole thing blows up in their face. I don't know if they'll be successful at it, but at least they're trying, something the Fed never really did.
Right, they're making a little bit of an effort to work off those excesses. Bill, the next question I really want to ask you, it's probably a question most people are afraid to ask. In your opinion, how much time can this go on? When do you think the next crisis will occur?
The Fed printed just an odd lot of money in the late 90s, and the economy hadn't been broken by them yet, but it didn't take too much of an irresponsible monetary experiment to cause a wild blow-off in the equity market. And then the whole country got involved, and we had the massive bubbles. Then they took rates too low, for a long time and precipitated a housing bubble, and that used leverage and all that. Now, the amount of money they've printed is so far off the page relative to anything that's ever been. As you pointed out, they printed $4 trillion. So to say that the timing of how that's going to unwind and when is insane. No one on the planet has ever seen anything like this. In history, there's never been anything like this. So there's no roadmap as to how wacko this can get and how long it can go on before it ends. I would say this. There's no way the Fed is going to get to zero on its tapering. Somewhere between this recent step and zero, the market is going to have a huge crack up exacerbated by all the hot money that went in and algorithmic trading. But beyond that, it's not possible to handicap how long it might last.
We haven't even had a 10% correction now in over a year.
Probably what we will have is some sort of a crash or crashette, like the flash crash, precipitated by something surrounding the tapering at some event, and then all of a sudden we'll have a very big market break, and then the Fed will eventually back off from tapering, and we'll be on to the next phase where maybe people start to talk about the fact that the Fed is trapped, can't create jobs, can't really create economic activity, can only create speculation, and in that period of time you have a chance for some further problems. But I think the equity market's got to crack first. But we're not going to be on the path the Fed thinks we're going to be on. We're not on the path to some self-sustaining recovery. The Fed is not going to get a chance to do what they think they're going to do. We will have rate rises somewhere down the road, but it's going to be because of some sort of a collapse in the bond market or the dollar as a consequence of these policies. So, the game plan the Fed has laid out is not going to happen. They don't understand what's going on. They didn't understand the bubbles. They didn't understand when the bubbles burst. They didn't understand anything. The most mind-boggling thing today is that the Fed has any credibility whatsoever, and people are back to believing they know what they're doing and they know the future, and they most definitely do not.
So these professors and these PhDs and MBAs, they're just flying by the seat of their pants.
No, they're just making it up. They don't know.
I mean, you're talking about a global economy. And these guys are actually out there right now still printing $55 billion a month.
Right. So if you believe in the Austrian school, that it sort of says when you're misallocating capital, you need ever larger amounts to fuel the party. Well, we're going in the opposite direction. Now, people that are bullish say, well, they're still printing $55 billion into their stimulus, So, yes, there still is. But, it ought to require an ever larger amount to keep this party going. And since they're taking part of it back, they're printing gobs of money, but they're kind of reducing that. And so you've got a massive amount of stimulus, but you've also got, a reduction in stimulus at the same time, and, that causes cross currents.
Has all of this easy money policy by the Federal Reserve caused food inflation around the world?
Well, it doesn't directly cause it, but it certainly, it monetizes it, so to speak, right? So it's easier for prices to go up when they're printing money. Obviously, weather has a huge impact on crops, but it foments speculation, and so it exacerbates the problem. It's not the primary cause of the problem, but it certainly exacerbates it.
My next question to you, Bill, and I really do appreciate all your insight. If the Federal Reserve continues this path, and it sounds like they have no other choice, it sounds like they really have no other choice. So just say the markets start to tumble and they say, hey, we're not going to taper, or we're not going to raise rates, and they go the other way. Won't the market just lose faith and credibility in the system?
Yeah. Well, that's the conversation. That's the next step. They have to lose credibility, and they will, because they're pursuing insane policies. But it's only when the masses conclude that the Fed is the problem that we can get upset about to fixing that and try to really solve our problems. But that's quite a few steps in advance at this moment in time. Yes, I think that will occur, but it's not going to occur, tomorrow.
So what is your take on gold and silver right now, or precious metals in general?
Well, I think the precious metals are really the only thing you can own where you're not fighting the insane policies, where the insane policies work to your advantage, and this investment will definitely protect you against the consequences of all that they have done. Now, in the last 2 years, when the Fed got really out of control, the gold market went down for whatever reasons it chose to go down. I think it's on its way back up, and I think the rise will get kind of nutty along the way as people really start to discover that they need some kind of protection. I mean, gold and silver aren't the only ways to protect yourself from these sorts of things, but it's a liquid, easier way to do it than maybe some other things. Obviously, rare art has gone berserk, and lots of things have gone berserk, and they would have protected you from these policies. But gold and silver are a way to say, I understand what these idiots are doing. I know what it's going to lead to, and this is how I'm going to protect myself. It's one of the few things that everyone can do to protect themselves.
Just have a little gold and silver on hand, absolutely. Now, gold topped out in 2011 a little over $1,900 an ounce. It's pulled back to around $1,200 an ounce. It's been on a rise since the start of the new year. Do you think that was just a natural correction in gold since 2011, since it went up for 10 years?
Yeah, I don't really know why it happened, but it did happen. Basically what happened was, a $2.50 stock in 12 years went to 19, and then it backed off to 12, and now it's starting to go higher again. Why did it go down when it should have gone up in those last 2 years? Well, maybe the length of the upside caused people to get sloppy. I don't know. And now why is it starting to rally while the Fed's tapering? When it wouldn't go up when the Fed was printing money? I can't tell you. Maybe some people are starting to recognize we're closer to the consequences. Last year the gold market absorbed, 4 years worth of ETF buying, that much selling in 1 year. So, there's a lot of pressure to the downside. So,
now, can people hide, say, in property? Is property a safe haven?
I don't know. I don't think all property is. Some might be, but other parts of it won't be. It kind of depends on every city, every county, every state. It's all different. The sun. For instance, the Sun Belt states. At the margin, the baby boomers are going to move there. They have that going for them. So every place has got a different dynamic. Some property will help, may protect you, and other properties won't. And I think it's very hard to have a blanket statement about that.
Now, before we end this conversation today, and again, I think it's a dynamite conversation, especially for our listeners, to take all of this in. We're looking at probably a period in history that we've never seen before, with all the money printing, not just by the Federal Reserve, but, as you mentioned, by the Bank of England, by the Bank of Japan, the problems in the European Union. What do you see? How do you see this European Union? Recently you've had the Athens market start to roar. You had the Spanish market start to roar. Is there any recovery there, or is it just the same thing that's going on here?
Well, there might be some recovery. The Greeks sponsored the ringer. I don't know much about Greece specifically, but this printed money it just flows around the world. So I don't know that there's that much recovery, but there's certainly speculation can move around quickly.
Okay, so basically it's just easy money lifting everything. Rising tide lifts all boats. That's pretty much it.
All right, guys. Great interview with Bill Fleckenstein. You can read more from him at FleckensteinCapital.com. And again, guys, it's been a pleasure to be with you today. Remember, we got an interesting week coming. Watch that key level. My name is Gareth Soloway here, Chief Market Strategist at InTheMoneyStocks.com. Let's make some money this week, guys. This is In the Money Stock Market Action on 820 AM News Talk Radio.